Hey traders, let's move on to the next video in the Forex trading series, which is video 9, and in this we're going to be covering patterns. So overall there are about 21 valid patterns that you could master and then go ahead and trade with, right? And many of them would include you playing around with the Fibonacci tool to be able to work out the different structures that the market is forming and using that. And most of them are just variations to the ABCD type of pattern, okay? But for our extent and purposes, there's only literally just a handful of market structures that we need to become familiar with, right? And we're going to run in through them. And if you're able to combine the market structural movement, like what we've discussed in the previous video with Elliott wave structure, with just a handful of the market formations, and then you utilize that knowledge and become aware of where to look for these patterns, and when the pattern formations happen, you figure out your entry, and that's it. That's more than enough for you to be able to make your 20, 30, 40, 50 pips, or if it's caught at the right place, 100 pips or more easily. Okay, so let's have a look at them first of all. So the most common one that you're possibly already familiar with is your double bottom formations. You've got the variations to that, which is the triple bottom formation, or what we would call the head and shoulders formation. Right? Then there's the other famous one as well, which is the double top formation. We've got the triple top formation, and then also the variation to that is the head and shoulders formation. Right? The other one that you'd probably become more familiar with is just the channel. Okay. A variation to the channel, which is one of my favorites, is the wedge. The wedge basically is a channel, but it narrows in. So you've got, or we'll do it this way. Basically, what happens is that the trend lines act as support and resistance lines, and the channel keeps narrowing. Usually, what we get is if this channel is or this wedge falls into an uptrend, what you'll get is where the market goes up like this, possibly towards the end of the first or the third wave in your Elliott wave structure, form a double top and then start coming down. Okay, so this will then, what we're looking for is possibly 5 hits. Okay, so it will go A, B, C, D, E before we expect that this market to continue going up. Chances are this wedge will possibly be this way. Sorry, coming downwards, so that if the market goes up like this, then in them doing this sort of stuff, this would be either 618 or 382 or even the 50 on a Fibonacci line, right? So this is another pattern, which is just a wedge, and there's variations to that. And the inverse of this would be true as well when the market is heading down. So you'll get a bit of a W formation, and then the market will just go A, B, C, D, E, and then come down again, right? Generally speaking, when you're watching a lot of videos, what you'd find is when people are talking about higher lows or lower highs, this is what they mean, where the wedge is kind of coming in, okay? With wedges, you can generally predict where the market's going to head to. So if this is in an uptrend, what you will get is that this market, is going to come back eventually towards this area, bounce off, and then continue going up, right? And there's going to be variations with what the market does around these points as well, because there might not just be a straight off bounce off here. What you might get is the market just extends out and does something along these lines before it goes up. And we will look at all of this in the live charts to show you some examples. And the channel, you can have triangles as well. I'm not the greatest fan of triangles. They operate similar to wedges, but with wedges, when they form and they're placed in the right areas in terms of Elliott wave structure, then what we generally find is that you could predict where the market's headed towards. But with triangles, usually what can happen is if the market is within a triangle structure, um, you won't be able to easily predict where this is going. Because with a wedge, what I will show you later on is one of my favorite trades in regards to a wedge is where when the market, for example, is here in the wedge structure, and you know this is going to continue going south, what you get is a bit of a breakout, right? This is where a lot of traders that are speculating on the market movement, um, they'll get caught up in this because they'll take a trade going long after the breakout, right? But what can happen is that the market can go up and create a M formation before it comes down again. With triangles, if you're not able to kind of tell the difference between a wedge and a triangle, what can happen is that the market will just bounce straight off the upper or the lower support or resistance line, do a breakout, and then continue going south. There'd be no retest. It'll just, you won't be able to tell. It's not easily predictable. So that's part of the problem. Let me just clarify the whole wedge setup again. Let me clear the board. So basically, what I'm saying is, if we've got the markets come down, and then it's entered into a bit of a wedge, right? What we can predict, because the market has fallen, say for instance, this is a fall from the fifth wave, so this is A, all right, and we're looking for a B structure formation before the market comes back down again. So what we're looking for is that the market's going to come down here, and at times this is going to break above this resistance line, and a lot of traders there will get caught because they're thinking this market's going to continue going up. It'll do this, and there are times when it will just hover there for maybe even a couple of sessions, right, before it will maybe do a stop hunt, or just from that point again it will start to fall, right? So with wedges, once you see this sort of a structure, one of my favorites, where once the market does start falling, then you can ride this quite substantially, and this may go for a while, 100 pips or so. So that's one of the benefits, right? Realistically, that's all you need to know. Okay, and here's the reason why. When we go back to Elliott wave structure, let me do this again. Sorry, guys, because that looks nothing like it should. I'm trying to get this to 618 of here. Anyway, that'll do. So we've got this to be first wave, second wave, third wave, fourth wave, fifth, and you guys know ABC, okay? So here's the thing. We've got our W, we've got the variations to that, which is the head and shoulders as well. You've got your M patterns, your triple tops, head and shoulders here as well, right? These are the most common ones that you will come across. You've got your channel and you've got your wedge, okay? And the inverse of that as well. If you understand the whole Elliott wave structure well enough, then there's only certain places within the whole structural system that you'd be looking to be able to trade off these sorts of patterns, right? And here they are. If the market's trending up, then what you're looking for is a W formation down the bottom here. You're looking for a W formation or your triple bottom formation or head and shoulders formation here. So same thing applies down here as well. You're looking for your head and shoulders formation here or triple bottom, and the same thing down here, right? So the most common ones, you'd probably get large double bottoms or head and shoulders down here. This will most likely just be a standard W formation or a spike to the low or something along those lines. In these three areas here, this is where you're looking for your double tops, your triple tops, your head and shoulders, or the inverse head and shoulders. All right, and the same thing here. Down the bottom here is the ones where there'll be big pattern formations. Same deal here where this part will go up and then you'll get either a retest. More often than not, and this is the most common thing, is where you'll get 3 hits to the high, right? It might form as a head and shoulders pattern, or it might just be where the market goes up and does these 3 hits to the high. What you will get here usually are big strong wicks. Okay, so your stop hunts will be massive. Same thing down here. Stop hunts massive here. Decent stop hunt here as well, right? Over here, yeah, you probably will. I would not be looking to trade the reversal here because this might not be significant, but these ones can be. Remember when I was talking about wedges, where if you've got a wedge formation happens, market breaks out above and then comes down. These are the ones that I'm talking about. When you get that breakout wedge here, which is your B corrective wave with the overall trend, these are the best places for you to be able to trade this, because you can reasonably forecast that once this market moves south, where this is coming to is 618 of this move here, which is from the base here, which is your third impulse wave, or the second impulse wave, but the third wave on the Elliott wave structure. So whatever the 618 point or 618% of this actually is, that's where it's going to come back to. That's what we're expecting, right? Can it come back to the 50? Yeah, absolutely. But from this point here, that breakout, that's your best friend. It's going to come down to that point, okay? With your channels, if the market is trending up, we're looking for channels here. Here and here. Okay, so when the market goes up and we've got a channel coming down, what we're looking for is possibly maybe five joints. Remember where I said earlier where you've got your M formation, right? So market comes down. This is your A, B, C, D, E. Around E somewhere here is when you'll probably get this sort of a thing happening where the market's kind of going sideways for a while, and then you might get a stop hunt low and then market climbs, right? So we're waiting for this confirmation, at least 5 hits, right? The A is always got to hit to the bottom here if the market is on an uptrend, right? And this again, if you're going to apply standard Elliott wave structure rules, this would be 618 or somewhere thereabouts, 618 to 786, and this is where the market is going to come and commune with most likely your EMA 200 or possibly even your EMA 50, okay, or EMA 200 on a higher time frame. So once the market moves up, we're expecting this to be, one of those massive king tides where the market just keeps going, extending out. You will get to possibly this might just be on Fibonacci expansion tool. This might be 127, or if we're lucky, this is going to go all the way up till 1618. There's a chance that up here somewhere, this market, when it does its smaller waves up this way, is that this might be 127 and this retraces back towards the 100% line and then continues to go up towards the top of this, okay? But the pattern formations will be exactly the same. Even within these small areas here, you're still looking for either your W formations, or the most common ones are where the market comes down, spikes up. This is usually where, around these areas are usually where what you'd find is that they'd hover there until there's a news release. So oftentimes, when you see where there is a news release, say for instance, it's bad news for the Aussie dollar, and this is AUD JPY or AUD USD, and the market's on a downward channel, what you might get is somewhere along here, the market will just spike down, hit this, and the very next candle goes all the way back up again, right? If it happens around here somewhere, or here somewhere, that is your entry, and you could possibly get your entry in before the market even makes it towards the resistance part or the resistance line of that channel, right, the upper line. And in that way, you could probably capture an additional 20-30 pips or so before it breaks out, does a retest, and then continues on his way, right? So just in that, see this elliott wave structure movement, you realize that this is pretty much all you need to know. Forget about the general ABCD patterns or the variations to that. This is all you need to know. And in doing this, you don't really need to speculate with your trades, because with a lot of all the trading systems out there, there's a lot of speculation, because we'll say, hey, we're expecting the market to come back to this point, to correct here, to correct there, and we're just going to take a pending order or something. But in this case, you don't have to, because you can see exactly what the market is doing. And this is what I mean when I say, if the market is going to show you or try and prove to you that it loves you, then it's going to come back and it's going to do these things. It's going to do your stop hunts at the right place. I get a lot of people that possibly will be looking at, say this sort of a structure. Remember when I said this whole area it could be a smaller version of the Elliott wave structure. So let me draw it in here. I'm going to do it this way slightly so you can have a look at the double top formation there. Okay. Now, say for instance, this whole entire part sits just here, okay? A lot of people seemingly try and look for an M formation here, right? Or a double top formation in those places. And that's when they say, well, I took my entry. Why didn't it go break past the 50? Chances are when you do that, this is either just going to hit, what is it, your EMA 13, EMA 18 line, or this is going to be your EMA 50, right? The chances on a 15-minute chart would be that your EMA 15 would hit on a higher, on this part here as opposed to the smaller ones here. But a lot of people seemingly look for double top formations in these areas here within this small area. And then that's when they get caught off, because the market will probably come down, hit an EMA, and then go boom, right? This is the reason why in my past videos I'm talking about the patterns are great, but you've really got to know where to apply the patterns. And for those of you that trade binary, the same rules apply. Remember when I'm saying you've got your double tops, your double bottoms, and you've got your fourth wave happening, or the second leg of either your M or W formation. And once you've got the stop hunt, the second candle, you could trade off a pullback, and chances are you're going to win that trade, right? That's good if you do it here. It's a valid trade if you do it here or up here. But if you're going to do it within the smaller part of just this movement here, where you're within this structure here, so here and here, chances are you lose your trades, because the market doesn't have to adhere to what you're doing. Okay, so yes, you will see lots of the smaller M formations or the W formations in these areas. It doesn't necessarily mean that that's still at the right place for you to be able to take your trade. Okay, so the idea is to find the overall structure, and then look at how the smaller structure fits into the smaller components of the bigger structure. Okay, makes sense, hopefully. Let's get out of this and let's go on to our charts to have a look. So let's go back to pound USD. That's the one we did the previous video on. Okay, so actually let's jump on an hour chart. These are your channels that we were talking about. Remember, if you had a quick look, that, and it's still valid, this guys, this is this week, so you can go back onto your charts and have a look at it. Not this week, sorry, in the last few weeks. So if you go into an hourly chart, you should be able to see this. So notice how here, this is a W formation or a double bottom formation, stop hunt to the low. Stop hunts can vary in how they are formed. There are times when it goes down, it hits this low candle straight up, and you can take your entries up here. Or there are times when the market will come down and then do this. You get a strong wick to the bottom before it goes up. So a longer wick that forms. And in this case here, on a higher time frame, that wick probably will show as a bigger wick. Okay. And then market carries forth. Now, notice how here, once the market's going up, we do get some formations like this, where, let me zoom in so you guys can have a look, where this could be perceived as an M formation or a double top formation. And same thing here. We'll say, hey, we've got a strong double top formation forming, because when you jump onto a 15-minute chart, this 5 or 6 candle formation would be lots of formations there, and even to the point where, see how this next candle comes down, that's 31 pips, right? Yeah, a lot of traders can trade that. It's not a problem, but that is still not where the pattern formation should be, or the ones we're looking for. That's not where it should be, because now we're still waiting for this market to actually have reached a point where it's hitting a wall up the top here, resistance area, and when it's doing that, it's going to then dramatically fall again and establish, hopefully, a channel. Okay, a channel or a wedge of sorts. Once it does, then let me zoom out again so you guys can have a better look. So here's the double top formation and starts to come back down again. Once it does, yes, we can possibly trade going south. I wouldn't exactly trade here, because what I want to do is I want this to kind of find a support area, which is in a bit of a trend line. Once you get that, let the market bounce off of that to go and find another point up here from which it can pull down from. It's only after this is formed where you can possibly grab this tool here, the channel tool, and draw your channel in, right? And you need to adjust your channel, because what you'd find with the market, it's not going to adhere to exactly the same spot all of the time. So once this is there and then market starts to come down, that's when you can use the tool, draw your channel line in, and then now wait for the market to come back to this point, right? You do know if the market continues falling, yes, you can look for your entries on the 15-minute chart. Let's have a look at it, actually. So notice how the market, and this is where a lot of people would have been confused, that once this double top formation happened, market just pretty much hugged this area, did nothing for pound USD for possibly 1, 2, 3, roughly 3 days, and then it went up to this point to find its top of the channel. So once it's done that, market starts falling, and look at this. This is quite a significant fall. A lot of people would be confused as hell here. That's when we can draw the channel lines in. You zoom out. We'll go into 1 hour chart, zoom out. And here's the thing. This is what the market is doing, right? What we want to do now is to find an area where we can draw our Fibonacci tool in, so we know that once price is up here somewhere, we're still expecting this to eventually find its way to our 618 area of this move. Why? Because we possibly have recognized this to be Elliott wave structure. Also, this line here for me says this is a possibly an EMA on a higher time frame. In this case, it doesn't really apply because we're on the 1 hour chart. But if this on a 15-minute chart, this does apply, because this is the EMA 200 on a 4 hour chart. Okay, so we are expecting price to come down to this point. Okay, let me jump back onto a 15-minute chart so you can see the pattern formation. When then you have either news release or something, and this possibly would have been a news release at the right place, right time, right? When then the market starts to fall, what you'd find is the market looks like it's hit an invisible wall. You get, this is a tweezer bottom, you get lots of wicks to the low, and then aggressive move going back up again, right? Even within our count on the 1 hour chart, where we could possibly count and say, okay, this goes up, this whole area here is our A, hit to the bottom line, B, C, D, and how I'm calculating, counting the letters is basically I want to hit to my lines. So D, and then wherever the E formation is going to be, most likely will be the last hit to the low before this market climbs. So back onto a 15-minute chart, we probably would have set all of this out. Chances are you could have traded this one, okay? This one, you would have waited for the formation to happen, the market to fall, before you draw your trend lines in. And by the time the market gets to this point here, that's when you're adjusting your channel line. And eventually, we do know that the market's going to find its way back to this point here, right? Binary traders, yes, you could possibly, when price goes up to this point, look at doing a reversal trade off that just for that 15-minute candle, okay? Now, what I'm expecting up here is when whatever nonsense the market is embroiled in, that eventually New York Open, it is going to give me a stop high, and what I'm waiting for, I'm not going to speculate. Here's the thing. I'm not going to be cocky enough to say as soon as price comes back here, I'm going to do a short trade speculating that this is going to happen. Because keep in mind, in real time, you've got no friggin' idea when it's going to do it. Because what if, say for instance, let me zoom out. What if the market continues to do this for another 2 or 3 sessions? So if you speculated and the market, say, came here, you'd be constantly out of the money for a number of days. We don't want to trade that way. So what we want to do is we want the market again to show us that it loves us. So the whole point is let it complete its formation and then give you a very strong confirmation candle. And when it does that, that could be your point of entry to say, yes, I know where this market is headed. 20 pips, 40 pips, how many ever pips you want to collect, and get the hell out of there, right? Once the market comes back to, say, 5 hits to our channel lines A, B, C, D, and E, and this is again most likely a news release, and we've got this aggressive move. This candle here, remember when I say confirmation candles, your confirmation candles are necessary to inform you that yes, we've done whatever we're planning on doing down here. We're going to get the hell out of there. That's when you can take an entry. Because from that point on, what you can reasonably predict, and remember when I say reasonably, it's a forex market we're dealing with. It could do anything. It could come back down and say, okay, I'm going to go ahead and do another hit to the low. So you don't know. So what we're reasonably predicting is to say that this is going to now continue heading up, right? Market does have a whole heap of its own waves. Price hits to the high, creates wicks. You can exit that trade whenever you want to. These are the sorts of trades, though, where I'd like to possibly stay within that trade and trail my stop losses. Remember, when you're doing your trailing of the stop losses, try and keep them below the 50. Why? Because remember when we said when the market does come back down to commune with the 50, it probably will give you wicks to the 50 or so. Where exactly on the 50? If you are comfortably in the money here, say 20 something pips, in this case, I'll probably just keep it below this red EMA here. In this case, again, once the cross happens, remember the communion here. Let me just see how many that is. Just from that point to this point, it's still 10. So if you could keep it still at about 15 or 20, maybe 20 pips would be better below the actual low, you're better off. So you would have been okay if you would have been in that trade. At this point, you're about 38 pips in the money, and then you let the market ride after this cross of the 50 and 200 and also this channel line. You let the market ride continually, right? What you're looking for now, once the market is broken outside of this channel, is that it will eventually give you a big tsunami wave and enter into another channel, which would be the 4th channel corrective wave structure. Okay, see these double top formations that you get here? Once you've broken out of this, you kind of should be aware that that's going to be a false move, because this is, so far, the Elliott wave structure requirements have been met, because where this happened was at 618 level. Okay, and we've also got the five wave count. Market's broken out, so I'm expecting this to keep climbing. If you were to ride that wave from here onwards, just to the tip of this is 281 pips, and that would be in roughly 2.5 days. Okay, so once this market goes up to this point, what I'm expecting, yes, is going to be a fairly decent double top formation. Yes, you could probably look at trading some of these. But again, the same rules in regards to your channel will apply, where once it's created a low and a high, use that information to create a channel. Let me just get rid of that. Okay, so what we're doing again here is multiple hits to the bottom, and again we're looking for a double top, triple top, or a head and shoulders formation. Where? Down here somewhere. Okay, notice how this market does what it's doing constantly. We're getting higher low formations happening, and then it eventually does a retest of the EMA 200 and climb. Okay. If you have a quick look, notice how the market constantly comes back to the 50 or the 200 to do the bounce off of that. Once you get this EMA 200 bounce, there's every chance that the market will continue bouncing off the 50. In this case, see how this has happened. If you've watched the previous Elliott wave structure video, notice how when the market breaks past this, comes back down to the 200, and then you got two hits to the 50. Before it reaches a peak, you've got here now what your triple top formations are happening. Why would you not take this to be your primary double top formation here? Because we've just broken out of the fourth wave from here, right? And as you have broken out of the fourth wave here, by now, what you should have done is grabbed your Fibonacci expansion tool, grabbed it from, say, here to here, right? You could have even done it up to from here. What I'm expecting is this will get to 1618. So see how there's an M formation here after the break of this channel? We still don't count that to be the end of our fifth wave, simply because we want this to hit our 1618 and go further. Oftentimes, what you might get is a 216 or a 2681 hit to the high before, or sorry, the 2168 hit to the high before the market does this. But keep in mind, there's always going to be variables to that. And then what we're expecting is our big king tides. This happened during news release last week. Market collapsed again here. This is a bit of a wedge formation. This is the one that I was talking about earlier. And usually where we're looking for our wedge formations are either the fourth wave, which is the second corrective wave structure, or when the market is in B formation of the Elliott wave structure. Okay, and here, this is how we trade that. Again, one of my favorite setups is basically we draw our lines in because the market will enter into some sort of consolidation, maybe accumulation for multiples of sessions, sometimes 3 or 4 sessions. Oftentimes you see this with the Euro pairs, where it pretty much looks like it's doing nothing after a significant fall. So quickly analyze, see where it fits into the Elliott wave structure, if it's in wave 4 or wave going into wave B. What you're expecting is that it will break out above if it's in an uptrend and then the market's breaking towards the low. What we're looking for is a breakout above this line here. Let me zoom in. So above this line here, where the market will then give you a double top formation. Okay? So here's what I wanted to show you. Last week was NFP week, right? This is what the market did. Gave us a double top formation. Here's another wick to the high. If we took our entries here, market consolidated before New York opened, gave us another wick to the high. This was the first 15 minutes, and then this is when NFP released. So notice how the structure of the market was established using a wedge. If you see these wedges form, there's a very good chance that you'd be able to decipher news releases. And with the next few videos, when I talk about the fundamentals of news releases, you'd be able to combine the ones whereby market structure will give it away to you as to what the possible news release will be. Okay, so just an entry from here for, we'll say just to the bottom of the New York session for pound USD, that's 127 pips. And it's the same rules apply. You have your stop losses up here and then you trail it as the market's moving down. Okay. So this is what I was talking about. This is the triangular formation that happens where the triangle is just capable of breaking and continuing out. Whereas with my wedge formations, what I really like is the wedge usually will give you a breakout in the wrong direction, so that will be your false move, and that gives you enough time to prepare for an entry going this way. Okay, so there you have it, guys. That's pretty much your formations at play. Let's just have a look to see what pound USD is doing right now. Okay, this is chances are this actually hasn't hit our 61.8 line. So go into an hour chart. Okay, get rid of this. So from here till, I'm going to take it just to the top of that. Chances are this price may come down to the 618 area before it rises back up again. And then once it does, I would expect either a formation somewhere up here or a formation down here. I will have a look to see what this market is doing shortly before I look to either follow this trend going south towards my 618 line. So saying from here to here, it's about 30 pips or so. What I might do is I might wait for the market to show me what it's going to do from this point, and then possibly just trade going up. But again, no speculation, guys. Wait for the market formations to happen before you take your entry. Okay? Look at that. Maybe there's news release as well. So just quickly, the only real patterns that you need to pay attention to are your double bottoms, triple bottoms, head and shoulders, your double tops, triple tops, and your inverse head and shoulders, your channel lines, and your wedges. Okay, that's about it. That's all you really need. And if you can place them in the right places, then you'd be able to win a lot more trades more often with very little drawdown. These patterns will give you the stop hunt, and once the market's moved up, you probably will be ready to ride those king tides or the tsunami waves quite readily. Unless the market comes back to do a triple hit, you probably have very little drawdown with your trades. Okay, all right, that's it for now.